Started. Welcome to the session. My name is George Aragon from Arizona State University. I'm an associate professor of finance. Thanks to David for inviting me to present some of my research. So just to kind of tell you a little bit about myself. Like I said, I'm an academic researcher for the last 10 years or so. I've been researching hedge fund industry. Got a couple papers on performance, liquidity, different roles of hedge funds as financial intermediaries, and recently I started to look at onshore and offshore hedge funds, in particular the differences in performance, organizational design, and investor capital flows into and out of these two different types of hedge funds. So I think it's a very nice opportunity for me to get some comments and some questions on my research. And what I have planned for the talk is to just discuss the results from this research. So it's an empirical study. I'm going to throw a lot of empirical facts out at you guys. And then I try and make sense of these results, because it turns out we do find, we meaning my co-authors, Hyuna Park and Liang, we do find significant differences in some important economic variables between onshore, and by that I mean U.S. domiciled hedge funds, and offshore hedge funds. That is, hedge funds that are domiciled in low tax jurisdictions like Cayman Islands and BVI. This paper was accepted in the Journal of Management Science. So if you want the complete version, you can find it in that journal. And then after I discuss the results and tell a story to try and rationalize these results, I'm also going to discuss some recent work that I'm doing that's related, that looks at broad trends in the offshore hedge fund industry, in particular trends in market share of different jurisdictions. So I think I found some interesting patterns, and I need some help to try and explain what we're finding here. Okay, so that's how I have set it up. What the paper does, so this is the published paper that I was asked to present, is we look at whether these two groups of hedge funds, onshore and offshore, are similar in three dimensions. First is the performance. So from an investor's point of view, what they care about is what are the after-fee returns to their investment. So is it the case that onshore funds perform the same as offshore funds or not? And then we also look at investor flows. So if from the manager's point of view, if one of my goals is to maximize assets under management, then I would care about these results, because I know, for example, if I set up offshore, to the extent that investors react differently to my performance as compared to if I were domiciled onshore, then that may influence my decision to set up shop in Cayman versus the US. So we're going to look at the investor flows. And lastly, we look at organizational design, okay, because what we have information on are the fees that are paid to these managers, so the performance fee, the management fee. We also have information on the liquidity restrictions on the investors in these funds, so lockups, notice periods, and so on. And we just see whether or not that there are systematic differences in these contractual features between onshore and offshore funds. And like I said at the start, we do find some important differences between these two groups of funds. So here's something from our sample. This is kind of to show you the coverage that we have. I'm not familiar with how much you know about hedge fund research, but there are the data that's available for academics, okay, is fairly limited, and what we can get are these publicly available databases that are used by hedge fund managers to